Forex trading is more than just spotting chart patterns or reacting to news headlines. To consistently grow your account, you need to understand the underlying economic forces that drive currency values. That's where economic theory comes in. Today on FX Limit, we're diving into the top 5 economic theories that every Forex trader should know. These aren't just textbook concepts, they're tools you can actually use to make smarter trading decisions. Let's kick things off with one of the most foundational theories, purchasing power parity, or PPP. This theory states that in the long run, exchange rates should adjust so that the same basket of goods costs the same in any two countries. It sounds simple, but PPP is a powerful way to gauge whether a currency is overvalued or undervalued. For example, if a burger costs $5 in the US and the equivalent of $3 in Japan, the yen might be undervalued. While this isn't a perfect day-to-day trading signal, long-term traders often use it to identify potential reversals or fundamental biases in currency values. Next up is interest rate parity. This theory suggests that the difference in interest rates between two countries will be equal to the expected change in exchange rates between their currencies. It's critical for understanding why currencies with higher interest rates often attract more demand. This principle is the backbone of carry trading strategies, where traders borrow in low interest rate currencies to invest in higher yielding ones. Monitoring central bank decisions becomes key here, and using tools that signal trend direction, like the apex trend indicator, can give you a visual edge when rates shift. Number 3 is the balance of payments theory. This idea connects a country's trade and capital flows to its currency value. If a country exports more than it imports, demand for its currency rises. But if it's borrowing or seeing capital outflows, the currency might weaken. You don't need a PhD in economics to use this theory. Just follow trade balance reports and capital flow data. And if you combine that macro insight with a technical indicator that shows when trends are shifting, especially one that doesn't repaint like the apex trend indicator, you're stacking the odds in your favor. Coming in at number 4, we have the quantity theory of money. It's the old school theory that says increasing the money supply leads to inflation if economic output doesn't grow at the same pace. Traders use this to anticipate the effects of central bank policies like quantitative easing. If the money supply is growing too fast, inflation could follow, and currencies might weaken. Being ahead of the curve with this theory means paying attention to monetary policy updates and inflation expectations. That's where having instant alerts for market shifts like what the apex trend indicator offers can be incredibly useful. And finally, number 5 is rational expectations theory. This one assumes that people and markets use all available information to forecast future conditions. That means traders aren't easily fooled. They price in expected moves before they happen. This can explain why markets react instantly to news, even if the actual change hasn't occurred yet. It's a reminder that by the time you hear the news, the move might already be priced in. That's why it's so important to combine economic awareness with real-time tools. For example, if a rate hike is expected and the apex trend indicator confirms an early bullish signal, you're not just reacting, you're anticipating. So how do these theories help you in the real world of Forex? They sharpen your intuition, guide your fundamental analysis, and help you stay grounded when the markets get noisy. But theory alone isn't enough. That's why at FX Limit, we created the Apex Trend Indicator to bridge the gap between economic fundamentals and price action. With accurate buy and sell signals, non-repainting alerts, and a powerful trend scanner, it complements your trading knowledge and puts it into action. Understanding economic theories gives you the why behind price movements, but having the right tools gives you the when. So don't trade blindly. Combine what you know with what you see, and let systems like the Apex Trend Indicator work with you. If you enjoyed this breakdown, make sure to hit that like button, subscribe to FX Limit for more trading insights, and drop a comment below telling us which theory you rely on the most. Thanks for watching, and as always, trade smart.